Welcome to Debt Matters. Our mission today is to really explore a structural issue, something that has become a fundamental driver of cash flow risk for credit control and, collections teams right across the UK supply chain.
It's a big one.
It is. We're focusing specifically on this phenomenon known as phoenixism and why it's found such fertile ground, particularly within the UK recruitment sector.
Right.
It's creating a massive headache for everyone who's owed money. This isn't just about chasing a late payment, it's about trying to understand and, well, mitigate a real structural vulnerability.
That's the core of it, really. We're analyzing a specific corporate maneuver where a business strategically sort of manages its own failure.
Manages its failure.
Yeah. Using formal insolvency mechanisms, it sheds these substantial accumulated liabilities, often it's unpaid tax debts, trade debts, only to immediately rise again.
Right, like the phoenix from the ashes.
Exactly.
Yeah.
This restart happens under a newly incorporated, financially clean entity. And this new company, it conveniently retains all the critical elements, the core operations, the client base, the staff, and crucially, often the very same management team.
So it's a way of legally resetting the financial burden without actually stopping the business.
Precisely. The commercial operation never really halts.
And this is the distinction we need to establish right away for you, the listener. We aren't talking about businesses just, failing due to honest economic pressure or a sudden downturn in the market.
Yeah.
We're talking about how legal frameworks, ones that were designed for business rescue, are being used to, well, deliberately jettison liabilities. The goal is asset preservation and debt abandonment, not necessarily a genuine business closure. Our analysis today is connecting the dots from a comprehensive review of this specific pattern, highlighting its frequency and its cost, particularly in the high-pressure world of recruitment and staffing agencies. Okay, so let's unpack this concept of phoenixism a bit more. Can you walk us through the strategic sequence involved?
Sure. It starts with a company, let's call it Oldco, just to keep it simple.
Oldco, okay.
So Oldco reaches a point where its historical obligations, let's say large arrears of pay, VAT, or maybe accumulated trade debt, they've just become this intolerable weight on the balance sheet.
Right, so it's dragging them down.
Completely. This debt is preventing them from operating competitively or, securing new finance. So instead of a slow, painful dissolution, Oldco enters a formal, really accelerated insolvency process.
And what happens then?
Almost instantly, its most valuable assets, the income streams, the client contracts, the talent database, the staff, they're all sold to Newco, a brand new, recently incorporated entity.
Yeah, in the classic Phoenix scenario, Newco is controlled by
The same directors, or people very closely connected to the management of Oldco. That's the classic move.
That sequence you describe it's so precise, and it leads to what we'd call the empty shell, right?
That's exactly the term. Oldco is effectively gutted. It just remains as the legal vessel that contains all the historical financial baggage, all the debts and liabilities that management wanted to offload.
And that shell is then just wound down.
It's wound down, formally dissolved, and the original unsecured creditors, your trade suppliers, the government, they're just left standing in a queue.
A very long queue.
A very long queue with nothing at the end of it. Since all the income-generating assets were transferred, the shell has little or, more often, nothing left to distribute. So that guarantees minimal or, zero recovery.
While Newco, the Phoenix, just carries on.
It carries on. It inherits the viable, ongoing business enterprise, the revenue stream, the client relationships, but without any of the old financial ballast that was dragging Oldco under.
And that's what's so frustrating for the people left behind. The actual business activity never stopped.
Never missed a beat.
So the tool that lets this all happen with such sort of surgical speed and effectiveness is often pre-pack administration. For our audience who might not be dealing with formal insolvency notices every day, we should probably clarify why this specific route is so popular for this kind of asset transfer.
Yeah, we should. Pre-pack administration is a formal insolvency tool. It was established to maximize the value of a failing business as a going concern.
Okay.
The crucial defining characteristic is speed. The sale of the failing company's assets, so Oldco's assets, isn't done after the administrator takes charge. Instead, the deal, the valuation, the identity, the purchaser, it's all negotiated, agreed, and documented before the company formally enters administration.
So it's all lined up in advance?
Completely. Once the administrator is appointed, the sale is executed almost immediately, sometimes within hours.
What?
And this ensures business continuity, it minimizes market damage, and crucially, it stops staff or clients from abandoning ship. In sectors like recruitment, where your primary assets are intangible data, relationships, people, that speed is considered paramount to getting the highest value for the assets being sold.
I understand the commercial logic there, and I know the administrator is legally bound to act in a way that preserves value for all creditors, but this rapid transfer, it creates a real dichotomy.
It does.
On the positive side, if you're a client of Oldco, you get seamless service, jobs are often preserved, and the administrator can argue they got the best available price for the assets by selling them so quickly to a buyer who was already lined up.
That is the stated legal and commercial argument for the pre-pack mechanism. Yeah, absolutely. And it prioritizes preserving the business enterprise itself.
But the pain.
The resulting pain is disproportionately borne by the unsecured creditors. For trade suppliers, for agencies, for the tax authority, the rapid prearranged transfer means that the valuable income-generating parts of the business are legally out of their reach before they even have a meaningful chance to engage.
Or to question the valuation or contest the sale.
Exactly. The core of the complaint from creditors is that the deal is done before they even knew there was a problem. It leaves their debt secured only by the shell company, which has already been emptied of all its value.
And to really understand the friction here, we have to look at the specific transparency mechanism that's meant to protect creditors. I'm talking about the requirements around SIP 16. What is that, and why is it so often criticized as being, well, not enough?
SIP 16, or Statement of Insolvency Practice 16, is basically the professional standard that governs pre-packs in the UK. Its core purpose is to mandate disclosure from the insolvency practitioner.
So they have to explain themselves.
In a way, yes. If the assets are sold to a connected party, so linked to the old management, the administrator has to provide a detailed statement. It has to justify the decision, explain why a pre-pack achieved a better outcome than other options, and, crucially, detail the relationship between the buyer, new co, and the seller, old co.
That sounds good in theory, a formal justification.
It does, but in practice, the criticism is twofold. First, the SIP 16 statement is often released after the sale is complete. So creditors are just presented with a done deal. They're informed, not consulted.
Right.
And second, while the administrator has to justify the transaction, they're operating under a specific legal mandate, maximizing the return for creditors as a whole. This is often interpreted as prioritizing the rescue of the business. So if the administrator believes the only viable option is a rapid sale to the existing management, the SIP 16 statement just becomes a justification for that decision. Critics argue it's inherently biased toward the new owner and against the unsecured creditors.
And when we look at the debt that's left behind in these maneuvers, one creditor profile consistently stands out as holding the largest balance of unpaid liabilities, HMRC.
Yes, overwhelmingly.
Why is the exchequer so disproportionately impacted? Why are they so often the single largest unsecured creditor in these specific failures?
It's a systemic issue, really. It's rooted in financial decision-making and also legal status. First, just look at the financial behavior. Management facing a tight cash flow has to make some really agonizing choices. If they delay payment to their recruitment software provider, that vendor might just cut off their service immediately, paralyze their business. If they delay the rent, the landlord might start forfeiture proceedings. These trade debts carry an immediate operational threat.
Whereas delaying tax payments, PAYE, VAT, it doesn't have that same immediate threat of shutting the business down tomorrow.
Precisely. HMRC is generally seen as a slow-moving long-term threat. While they can and do issue winding up petitions, the time lag involved often means management prioritizes paying the suppliers to keep the lights on and the payroll running. They defer the non-critical cash outlays, and that includes tax.
So the tax liability just builds up.
It accumulates over months, sometimes even years. And when the firm finally enters administration, those large historical VAT or payee balances are classified as unsecured debt. Critically, they represent a massive aggregate balance that has no specific asset security against it, unlike, say, a bank charge or a retention of title clause held by a trade supplier.
So we've established the mechanics and this strategic abandonment of debt. Let's try and quantify the sheer scale of the financial toll this practice takes. This is where the numbers start to paint a very clear picture of the cost to the UK economy.
That's correct. The initial sort of broader estimates provided by HMRC suggest that this practice, encompassing these strategic insolvency maneuvers and subsequent restarts, drains roughly $800 million a year from taxpayers.
$800 million.
That's the estimated amount of tax revenue that's deemed unrecoverable because of these specific repetitive insolvency patterns.
And the analysis we've been looking at, which drilled down specifically into failures in the recruitment and staffing sectors, suggests that number might even be a little light.
Indeed, a more focused, granular analysis of the liabilities abandoned through these accelerated procedures refine that figure upwards. It suggests the cost specifically attributable to Phoenix-type activity is closer to $840 million per year.
So the focused research validates and even slightly increases the initial estimates.
It does, which really just underscores the prevalence and effectiveness of this mover for shedding tax debt.
And to help our listeners grasp the gravity of 840 million in the context of corporate noncompliance. I mean, that figure represents a really substantial chunk of the overall tax losses for a typical fiscal year.
It provides the necessary perspective, yeah. When you analyze the total reported tax losses for the period from 2022 to 2023, that $840 million makes up approximately 22% of that total figure.
22%.
Let that sink in. Almost a quarter of all corporate tax loss from business failure is linked directly to this one specific mechanism: the deliberate abandonment of liabilities, followed by a corporate restart.
So this isn't just a loophole, it's a primary driver of structural tax leakage.
Absolutely.
And to move from that abstract 840 million to some concrete examples, the research highlighted several specific companies in the recruitment space that went through this exact process, where huge unpaid HMRC balances were a central feature of the administration. These aren't hypothetical firms.
No, absolutely not. These are real-world case studies. The names cited in the analysis were highly recognizable within the staffing sector: Russell Taylor, Sylvan Recruitment, Qualiteach, and Premier Group Recruitment.
These are established companies.
Very established in a highly competitive market. When they hit financial distress and entered administration, the public filings and the administrative reports consistently revealed large, historical, and unrecoverable tax obligations.
And then the operation continued.
Invariably, a mechanism was used that allowed the core trading operation to continue, often under the same leadership structure, but free of that monumental debt. This consistent pattern across multiple named firms just clearly illustrates that the structural pressures within recruitment make it exceptionally vulnerable to this type of strategic liability shedding.
So let's pivot now to the collections team on the ground. When they get that official administration notice for a large debtor, their whole world changes overnight. The debt recovery equation moves from a commercial process to a legal one, and for an unsecured creditor, the odds just plummet.
That transition is brutal. It's immediate. Before the notice, the collections team has commercial leverage. They can threaten to cut off supply, they can impose late fees, they can start court proceedings against a going concern.
Right.
After the notice, they transition to standing in a long creditor queue. They are immediately behind secured creditors, often behind any remaining employees for wages, potentially behind HMRC for certain prioritized jets, and always behind the administrator's substantial fees and costs.
Which get paid first.
Always paid first. For the typical trade supplier, the unsecured creditor, the prospect of any real return just evaporates instantly. Recovery often amounts to fractions of a penny on the pound, or, most commonly, nothing at all.
And the frustration is compounded by what we call the ghost debtor problem. The legal entity that you contracted with, the one that owes you the money, is now functionally extinct. It's a hollowed-out shell destined for dissolution, legally incapable of repaying anything.
But the business is still there.
Exactly. The functional business, the one that employs the same people, uses the same website, and generates income, is still actively trading. It's like chasing a phantom.
And it creates a massive crisis of market discipline. If we connect this to the bigger picture, the knowledge that management has this reliable legal reset button, a mechanism to wipe the historical slate clean and keep the operations, it just fundamentally weakens the deterrent effect of non-payment. Why would a manager facing a cash crunch prioritize paying non-critical long-term debts like accumulated tax or services from a passive supplier when they know they can just shed that debt and continue trading almost unimpeded?
It effectively acts as a subsidy for poor financial discipline, or worse, outright financial recklessness. The firm that operates with weak controls, or one that aggressively manages its debt by intentionally putting off tax payments, gains this temporary artificial competitive advantage.
Absolutely. This is the heart of the unfair competition complaint. Compliant firms, the ones diligently managing their cash flow to pay their payee, their VAT, their national insurance, and their suppliers on time, are burdened by those costs.
They're operating on genuine tighter margins.
Exactly. And they find themselves structurally undercut by these Phoenix competitors who accumulate massive arrears, use insolvency to clear the ledger, and then restart with a completely clean balance sheet.
That ability to shed past burdens allows the Phoenix firm to temporarily bid lower.
Or operate with inflated cash flow, or simply take on projects their compliant competitors couldn't touch without having adequate reserves. The playing field becomes severely tilted. Ethical and financial responsibility is effectively penalized.
So beyond the government, let's detail which specific commercial groups are left stranded when the Phoenix flies. Who are the unsecured trade suppliers that find themselves holding worthless debt?
It's a huge network of suppliers who assume standard commercial credit risk. Just think about the entire operational infrastructure supporting a modern recruitment firm.
Right.
You've got the highly specialized payroll software vendors, the CRM platforms that manage all the candidate data. You've got marketing agencies and job boards like LinkedIn or Indeed that are essential for getting talent. Then there are specialist consultants who provided legal or HR advice, landlords expecting commercial rent, the utilities, and crucially, training providers who deliver essential staff development courses. All of these entities provided value on credit terms based on the stability of Oldco, only to watch that value transfer to Newco.
And we mentioned the clients, the end users. They benefit from continuity, but are they really insulated from the risk of dealing with a Phoenix company?
Well, clients get immediate continuity, which is the prepack's primary selling point, but they do inherit risk.
How so?
They face increased reputational exposure by dealing with a company that needed to shed, as we said, 22% of its tax burden. More practically, they face elevated operational risk. If the firm showed the kind of financial instability that required a massive restart, there's an increased chance that future compliance, particularly around complex areas like worker status or timely payment down the supply chain to umbrella companies or subcontractors, might also be under pressure in the new entity.
So the underlying weakness is still there.
The underlying structural weakness and potential for poor financial governance are now known, quantifiable factors that the client has to monitor very closely. This raises a really fundamental question that credit teams have to answer. Why is the recruitment sector so acutely prone to this specific type of Phoenix activity? It goes beyond just isolated examples of poor management. It stems from structural pressures that are inherent to the staffing model.
Okay, so talk to us about that structural fragility. What is the fundamental mismatch in the staffing cash cycle that makes it so vulnerable to rapid default?
It all comes down to the inversion of the payment cycle. Recruitment agencies, particularly the ones dealing with high-volume temp or contract staff, operate on razor-thin margins, often 5 to 15% on a very high turnover. The critical pressure point is payroll. They are legally and morally obligated to run weekly payroll for maybe thousands of contractors. That means a substantial cash outflow must happen every Friday.
But their clients.
Exactly. Their clients, who are often large corporate accounts, operate on standard credit terms of 30, 45, or even 60 days. This creates an immediate and sustained cash flow gap. The agency has to finance its own weekly payroll using its working capital, often while waiting 4 to 8 weeks to get paid by the client. If just a few large client payments are delayed, or if a tax liability is deferred to bridge that gap, the financial spiral accelerates incredibly quickly. It makes them highly susceptible to forced insolvency and the perceived need for a corporate reset.
Okay, so understanding that structural pressure, we can now refine the early warning indicators. For collections and credit teams working with these agencies, what are the red flags that move beyond just a general late payment and signal that a firm might be actively planning a strategic failure or restart?
Right, this is key. The initial behavioral signs are vital. Beyond general lateness, you need to look for inconsistent payment patterns.
So not just paying late, but erratically.
Precisely. Instead of paying a 30-day invoice on day 45 every time, they pay on day 40, then day 60, then a small part payment on day 70. This suggests manual, frantic payment decision-making based on immediate incoming cash rather than any predictable processing.
And as you mentioned, paying attention to the specific timing of any requests is key.
It's a 5-alarm fire. Any repeated request to stretch terms that specifically aligns with or immediately follows their Friday payroll cutoff date is a huge red flag. It means they're using your credit as an emergency, interest-free, short-term loan simply to meet their statutory payroll obligations. You are now subsidizing their most immediate operating costs.
That indicates a total breakdown in working capital management.
A total breakdown.
Okay, shifting to the legal and structural red flags, what changes in the corporate setup should collections teams be monitoring?
You have to become a bit of a detective, monitoring companies' house filings. Look for sudden, unexplained changes in the legal structure. A new holding company is incorporated, a sister company is registered at the same address, or there's an unexplained change in the key trading name, bank details, or billing entity without a clear commercial reason.
And the directors.
The most critical legal red flag is the frequent churn of directors or shareholders, especially if they are moving between various recently formed entities. These are often the preparatory legal steps being taken to ring-fence assets or set up the clean purchasing vehicle, the new co, before the official failure of old co.
And what about the subtler pre-administration legal signals?
This moves into the tactical realm. If you have a big exposure to a large recruitment agency, you should be monitoring for any company's house filing that indicates a notice of intent to appoint administrator.
Ah, so that's a crucial signal.
It is. It precedes the formal administration. It's a legal protection that stops other creditors from taking action for a short period, giving management time to finalize the pre-pack sale. A collections team spotting that filing knows immediately that the pre-pack is probably underway, and their mode has to shift instantly from collections to damage control.
Finally, we have to scrutinize the formal financial filings, as slow and frustrating as that can be.
Deteriorating financial filings are vital confirmation. Late account submissions, just a simple failure to file on time, suggests internal chaos or attempt to delay bad news. Look for qualification notes from the auditors, which indicate serious accounting or solvency concerns.
You have to look at the history, too.
Track the history. Have they attempted multiple informal or formal restructurings in the past? That pattern strongly suggests management is using repeated short-term fixes rather than addressing the structural viability of the business. And don't be fooled by small payments. A pattern of small, inconsistent part payments is often just a stalling tactic, a management technique used just to keep individual suppliers quiet and stop them from cutting service or escalating to legal action.
Okay, we've identified the vulnerabilities and the critical red flags. Now we pivot to the practical. What are the concrete, high-level actions a creditor should take to mitigate this risk before the insolvency notice arrives?
Mitigation has to start with dramatically enhancing your monitoring and due diligence right at the start of the relationship. A single credit check is not enough. You must run deep director and company link checks to see the entire group structure and identify all connected entities before extending any material credit.
Because a director who has failed companies before
Represents a quantifiable risk, regardless of how clean the new entity's balance sheet looks. You have to connect the dots based on the people involved.
And what about internal policy? How do we establish early warning triggers that force proactive action?
You need to set internal triggers that are both early and objective. For example, a missed payment plus the debtor failing to return 3 phone calls in 48 hours should automatically trigger an immediate high-priority internal review, a review of your contractual rights to terminate and your total financial exposure.
So don't wait for 90 days of delinquency.
Absolutely not. Act fast on the first sign of evasive behavior coupled with a financial breach.
And risk reduction must follow swiftly once that alarm is raised. How do you reduce exposure practically without just losing the client?
The only way is to reduce the credit you've extended. For higher risk accounts, shorten your payment terms dramatically. If you are on 60 days, move to 30, or even implement 14-day invoicing. Where your service allows, shift the financial demands upfront. Move to staged payments or require upfront deposits that cover your immediate cost of supply.
Or pay to continue milestones.
Exactly. For ongoing service contracts, establish pay-to-continue milestones. This means to maintain access to your service, your software, your data. The debtor must keep their account current. It aligns their operational need with your financial protection.
And finally, strengthening the contracts themselves. This is the foundational defensive layer. We need specific detail on how to make these legally robust.
Contractual defenses are your ultimate firewall. First, ensure your contract precisely and formally states the contracting entity's full legal name and registration number, and check this against current company's house records.
And termination rights.
Second, and crucially, strengthen your termination rights. You must include robust ipso facto clauses. These clauses explicitly give you the right to terminate the contract immediately upon a defined insolvency event, like the filing of a notice of intent to appoint administrator. While the law has sometimes restricted these, they remain vital for asserting control as early as possible.
And what about securing the debt against the broader group or the individuals responsible?
That is your second fundamental step. If the risk is high, or if the entity is small, require personal guarantees from the directors themselves. This transfers the liability from the soon-to-be hollowed-out shell company, Oldco, to the individual who controls both Oldco and Newco.
Or a parent company guarantee?
Alternatively, if the debtor claims to be part of a larger, financially stable group, demand a legally binding parent company guarantee. Make sure it's drafted robustly, detailing that the parent entity is jointly and severally liable for the debt. That creates a massive firewall against the simple Phoenix maneuver.
So when that structured risk assessment confirms the company is structurally distressed, the collections tactic has to pivot. We discussed acting earlier, but not necessarily louder. What does that strategic approach look like?
It does. Acting earlier means initiating a structured engagement before the 60 or 90-day mark. It means moving away from aggressive, panic demands, which just make management hide, and focusing on getting the key financial decision maker on the phone. The owner, the finance director.
And the objective isn't just to demand payment.
No, it's to conduct an affordability check.
Confirming affordability, what does that actually entail in a high-risk scenario?
It means forcing realism. You confirm what they can realistically afford to pay and when. You push for a realistic, documented, and written repayment schedule. It has to be concrete, with specific dates and specific amounts. You're looking for a clear commitment.
And if that commitment is broken,
It immediately justifies moving to formal action. You're trying to move the relationship from an informal collections chase to a formal legal agreement on repayment.
so the speed of response once that written schedule is broken is paramount.
If they fail to meet that written, agreed-upon commitment, even by a day or by a fraction, you have clear, documented evidence that their cash flow projection was either dishonest, unrealistic, or just completely out of control.
The time for patience is over.
It's over. You must immediately pivot to formal legal action or contract termination. You switch from hopeful collections mode to insolvency mode instantly to protect your position. The worst thing you can do is accept a new, second, verbal promise.
And if insolvency does officially hit, the administration notice arrives, the collections team has to make an immediate mental shift. What's the required action?
The shift must be absolute. Stop assuming recovery. That mentality is financially ruinous. Your first legal action is to submit your proof of debt quickly and correctly to the administrator. This ensures you're formally recognized in the process.
And after that?
After that, you must become an active, educated information seeker. Don't passively wait for a report. You must ask direct, pointed questions about connected party sales and the specifics of the prepack. Who bought the assets? For how much? What was the justification for the valuation? What is the demonstrable connection between the old management and the new entity?
This moves into the territory of potentially challenging the director's conduct if you suspect asset stripping or misconduct, understanding concepts like wrongful trading.
Exactly. When creditors suspect improper movement of assets, they must understand the concept of wrongful trading. This means the directors continue to trade the company past the point where they knew, or ought to have known, that the company could not avoid an inevitable insolvency.
And you need evidence?
Providing evidence of this, internal documents showing cash crisis warnings or knowingly racking up massive tax debt, is crucial. This evidence can be submitted to the administrator or to regulators to assist in potential director disqualification proceedings.
And if the creditor suspects transactions were at an undervalue or that the pre-pack sale was biased?
The timing is absolutely critical. If you suspect assets were sold at an undervalue, you are playing catch-up, and you must take specialist legal advice immediately. The window for challenging these transactions or for providing information to the administrator is often very tight and governed by strict legal deadlines. Creditor intervention needs to happen very quickly after the administration begins.
Now, in the interest of impartiality, we do have to acknowledge that insolvency procedures aren't always malicious. They are necessary legal mechanisms.
They are, and we must maintain that balanced view. Insolvency procedures are designed to maximize recovery and, where possible, rescue commercially viable operations, protecting employees and supply chains. Not every corporate restart is an act of calculated wrongdoing.
Right.
Many directors genuinely fight every possible avenue to avoid administration and will argue that the pre-pack achieves the single best available outcome for the majority of stakeholders under dire circumstances, even if it results in the abandonment of unsecured creditors.
But regardless of the director's personal intent, the core mandate for the credit control listener must remain simple, defensive, and focused on self-protection.
Correct. From the collections and credit risk management perspective, the lens is purely pragmatic. It's based on financial results. Whatever the management's intent, the financial result for the unsecured creditor is often zero recovery.
So your controls have to assume the worst.
Therefore, your credit risk controls, your contractual measures, and your internal triggers must always assume the downside scenario and be robustly structured to prevent the liability from falling solely and disproportionately on your balance sheet.
We have spent a good deal of time today dissecting the structural cost of phoenixism, which the analysis quantified at around 840 million annually. We've identified the systemic warning signs, particularly those inherent in the fragile cash flow of the recruitment industry, and detailed the immense power of proactive contract management and early structured engagement.
And that leads us to a final thought for you to carry forward as you review your credit risk policies. Given that this practice of management restarting debt-free accounts for nearly 22% of all reported corporate tax losses, how might the implementation of mandatory, rigorous public transparency requirements for pre-pack sales, specifically demanding clear, independent reporting on connected parties and detailed valuation methodologies before the sale is executed, affect the recovery prospects not just for the public sector, but for all unsecured trade creditors in the future? It's a crucial question of balancing corporate rescue with true commercial accountability.